Okay, very good morning. Monday, the 24th of July. Hope you all had a good weekend. A good weekend for Britain in terms of the sporting world. Well done to the women's cricket team, beating India in the World Cup. And Chris Froome, probably one of the most underrated British athletes, 4th Tour de France win. So, still, despite Brexit, punching above our weight against our European counterparts, at least for the time being, and on the global stage. At least we can say that for those two individual things. But as we're going to see in the news, maybe not quite the same from a IMF growth perspective. But at least something a little bit more positive, at least coming out for Britain. But getting down to the detail of the briefing this morning, and first of all, just kicking off with some economic data that we've just seen. And actually, it's probably some of the most important data that we'll get this week that's just come out. And that is the manufacturing and service PMI data for the month of July coming out of the various European countries. Now, this is important because these are the flash readings. So these are the first readings for the month of July, and tend to be then much more market moving than the final prints we'll get in a few weeks' time. And just quickly showing you what the numbers look like, just transitioning my screen. This is the German manufacturing PMI. That's just come in at 58.3. That's below expectations of 59.3. And then if we look at the service number, that's just come in for Germany at 53.5, below the expected 54.3. So both manufacturing and services, you can see here, has started to weaken on the service side consistently for the 3 months in a row now, of manufacturing just coming off the peak that was seen in the prior month. Meanwhile, from a French point of view, I'm sorry to say to Philippe, but the key business survey of the French economy has revealed a slowdown in activity in the Eurozone's second largest economy. So as you can see, manufacturing manufacturing is picked up slightly, but the service number and the overall composite is coming off its best levels. So you've got a bit of a slowdown in economic activity in France and a miss both manufacturing and service levels in Germany. So a little bit of downside just occurring in the euro currency here as we've just gone through those data points. Nothing really too drastic, but just sitting below pivot for the time being. The DAX index is currently sitting at its, or close to its session low. We had the low point from what was Friday's session in the afternoon. We had a brief flirt beneath that level, and you can see it's just providing a bit of a floor for the price action at the moment. But on the session change, we are seeing a slight negative at this present point in time. Consequently then, slightly softer euro, slightly negative DAX, so weaker economic data. So the Bund on the front foot since Europe has come in. Granted, it's only just now turning into positive territory. Again, finding a bit of a floor around the pivot level. Upside R1 62.58. That's just above the Friday high that was printed at 56. So a level there just to keep an eye on for the morning. Just getting down into the actual news flow though, and then we'll have a look at each individual kind of asset class as we go through the various different headlines. And starting off with something I saw late yesterday. This of course is Alexander Novak, the Russian energy minister, and the headline, Novak says OPEC, non-OPEC to discuss Libya and Nigeria. So speculation has been swirling in the oil market that the meeting might ask Libya and Nigeria to join a production cutting deal, which they are currently exempt. Remember, the deal that was put into force the end of November of last year was then extended for a further 9 months. Earlier this year, that has Libya and Nigeria, because of the civil difficulties that they've had and disruptions to their supply, they are exempt from the deal. But just given the fact that oil has remained fairly heavy, the likes of Russia, obviously the country, the largest clout from a non-OPEC perspective, have been, mooting the point of, do we need to get these other countries involved? Now, this is what happened yesterday. The actual latest this morning has come out of a few other comments. Libya and Nigeria oil output caps said to be ruled out for now. Now, just in terms of wording, when Bloomberg say said, what they're basically saying is they're quoting sources as suggesting. So this isn't actually official. This is just what sources would suggest, that irrespective of the fact that, so today OPEC and non-OPEC meeting officials are meeting to discuss, I believe it's in St. Petersburg, the current state of play of compliance and whether they need to do anything additional. But the latest sources would suggest that no output caps are under discussion at this point. Certainly though, when all these countries come together, you definitely need to be mindful of keeping an ear on the squawk and also an eye on Twitter for any breaking news. You kind of know the drill by now. OPEC and non-OPEC producing nations love to talk off the cuff, and hence then high probability of volatility in the price of crude oil in reaction to that kind of commentary. Just having a look at WTI crude, the low print that was seen kind of late last week around what would have been the traditional NYMEX pick close kind of time. We've had a little test at that this morning, not broken it as yet, but we're slight negative, albeit only marginally 13 cents, but 45.54. Any break of there probably bring into play then the low that was seen on the 13th on the morning of 45.16, and then you got the 45 psychological handle with 02 marking the S1 on the session. I guess for the week, if we did remain heavy, then obviously 44, and then just below there is that low print from the 10th that was seen at 43.83, which would open up a move back down to levels not seen since around late June. Obviously, just be aware though of if there is unscheduled commentary, the likelihood is it would be sources or off-cuff comments indicative of potentially action being taken. If that were the case, then obviously you could get spike higher in price. But what we've seen become more of a familiar pattern, I'd say, with oil, is that despite the spike, it tends to be getting shorter and shorter lived as people are starting to look at this kind of bigger idea or expectation that crude will remain heavy for the period ahead, with US output, the oversupplied nature of the market, and so on and so forth. Okay, a look at some of the other headlines. This was one from the weekend. Macron, the European kind of golden boy, a little bit of popularity just fading of late. The French president approval rating has fallen sharply in the past month, as French voters were either confused by plans for the tax system, shocked by a dispute with the head of the army, or unsettled by upcoming labour laws reform. If you'll remember, I think it was a week or two ago, a big argument between the head of the military in France and Macron, because Macron was actually going slightly against a commitment where he is looking to actually withdraw some funding for the military. The head of the military then saying that this is unacceptable because it's not enough now for us to protect the nation as he sees fit, and so he resigned. He was a fairly long-serving senior member of the military, and so that and then now that we know that Macron, given the second round of voting that took place in the National Assembly, so the parliamentary structure gives his party quite a lot of power, means that he can push forward some of the labour law reforms. And again, these kind of disruptions or changes on that front maybe have just seen some of his popularity decrease. But overall, has this had an impact on the market? I don't really think so. I think that it was kind of inevitable. He had such a strong start to his presidency. I think it was only really a matter of time before that would have started to, that euphoric kind of response started to fade, and then hence you've seen a little bit of this reflected in the polls coming out. Just coming back to the charts, what's really moving the market though is the data this morning. So just eyeing the euro here, just coming back down towards S1. Again, this is the weaker than expected German survey PMI data missing expectations this morning, with France a little bit mixed as well, but overall business activity slowing. A quick look at the latest ECB headlines. This is Yves Mersch, who said that unconventional monetary policy tools used since the global financial crisis are unlikely to remain necessary as the global economy and central banking normalise. So this is part of that more kind of hawkish tilt that we've had from the ECB. Although we've moved a little lower here this morning on the back of that data, just put into context where we are at the moment in the euro currency. If I just start looking further back and I just remove my pivots, you can see here a really key technical level that we've just been testing. It's going to be interesting to see, obviously, the data maybe just helping also fundamentally turn this price off this key technical point. But it's going to be really interesting to see whether we can get above here, because if you look back to the summer, really, or I'd say Q2 of 2016, the summer of 2015, whenever the euros got up to around this 117 price point, that tends to be a fairly significant barrier for then the price moving any higher here. And obviously this has come, that little circle that I have here on the far right of the chart, that was the centrist speech, the ECB forum, when Draghi started turning more hawkish. However, with inflation looking less convincing, i.e. moving further away from target, and if we start to see some softness materializing in European economic data, obviously don't want to read too much into what we've just seen this morning. You'd need a bit more data to follow suit in a weaker fashion. But would we start to see a bit of profit taking off of this pretty exceptional rise that we've seen over the last few weeks, and a bit of a pullback from this point? Again, 117 is significant from a technical perspective. And just looking on the 30-minute chart here to encapsulate that rally that we had from the ECB meeting, obviously from a profit-taking point of view, there's definitely a bit of a scope for that. From here, you've got that post-ECB spike kind of support that was seen that evening, and then the following overnight Asia-Pac session before we lifted again. So on the downside from here, if we do trend any lower, I'd be keeping on 116.52 there. But certainly ECB members, from a commentary point of view, still keeping up the rhetoric of sounding more hawkish. Again, this is all in the expectation that it will really be come September when they start talking about this unwinding of QE in a little bit more detail, or tapering it down, I should say. Other headlines from this morning: the IMF have released their latest global GDP update. They've maintained global growth forecasts. Interestingly, China and the Eurozone have revised higher. So despite, again, some of this weakness in European data this morning, overall, European data has been tracking at quite multi-year high levels, actually. The one country that is suffering, despite China and Eurozone getting upgraded on their growth prospects going forward in the eyes of the IMF, is, of course, the UK. The UK, the recipient of growth forecasts being cut at the IMF for the first time since the Brexit vote aftermath. So what we're looking at here on this chart is the various different forecasts for growth going forward for the UK. So what the IMF are anticipating, which is probably the consensus amongst the financial community, is that going forward, given the squeeze on the consumer felt from anemic wage growth and higher prices, is that economic growth is going to gradually slow down. This evident, of course, in data as well. And to support that argument, overnight you've had market stress that UK households are facing their sharpest squeeze now in almost 3 years. Now, if you remember last week, if we go back to cable, we had a pretty interesting week for cable last week for a number of different reasons. But if I just go back to, well, I've got it marked up here from a discussion that I had on Friday, and this is the first rectangle. That's predominantly dollar weakness, which fueled the pair higher. That was after US CPI was below expectations and US retail sales were weak. That saw cable vault the 130 handle, as you can see there. And then we had, of course, the inflation readings which came out of the UK. And so we started to weaken midweek. We obviously peaked up at 131.53, but then inflation came out at 2.6 rather than 2.9%. And then we've had some question marks back about Trump and a widening investigation probe. Maybe that dollar weakness at the end of last week's just helped support a bit of a floor, and here we are still sitting at around the 130 level. But we had retail sales last week, and despite it being better than expected, we actually declined, don't forget, on the back of this. And that's because the bigger picture here is exactly this reason. The British household's financial situation is deteriorating at its fastest rate in 3 years. Families increasingly shying away from big kind of ticket items, cars, holidays, household appliances, reflecting an ongoing squeeze on household incomes as inflation rises. As we know, still even at 2.6%, is still higher than the rate of wage growth. And so despite that one-off hot weather conditions helping elevate the June retail sales report, overall that number should weaken, as well as other UK economic data points, and hence the reason why sterling's remained relatively heavy. I guess the only things to question here about the direction longer term for cable, because if we look at cable on the longer term, it's still fairly elevated in comparison to, just looking here, this was the 120 was the really big level that we tested post EU referendum. This was really when Theresa May started talking up hard Brexit for the first time, and then we had a retest of that level. Would have been back at the beginning of the year, but since then we've remained fairly strong under this inflationary conditions. But I would say that for now an interest rate hike from the Bank of England has fallen away, so that should be a net resistance, if you like, for price to move any higher. The question marks are, is the dollar going to weaken any further? From the beginning of the year, the dollar has weakened substantially on the back of, I guess, the risk of an increasingly hawkish Fed has started to diminish as inflation stateside as well has looked less than convincing in terms of remaining near target. If anything, it's been dropping off. Economic data has also been starting to show some signs of softening in the US, and more importantly, Trump continues to be involved in various probes and scandals, investigations and so on and so forth, and his business activities and Russian relationships. So if the dollar keeps weakening, that might just about help keep sterling stronger. Not because sterling is strong, but because the dollar is weaker. But one would think that given the Brexit talks and the way they seem to be shaping up at the moment, which essentially hasn't really seen a lot of progress because we haven't really made much ground on this divorce bill or settlement in order to get more concrete discussions underway, then it's a battle at the moment out of who's going to be weaker, the dollar or the pound. And at the moment it seems the dollar weakness is helping provide a bit of a floor for this. So it's definitely going to be interesting. Whether or not now, if we look at where we are in cable trading at 130.34, 131.53, is that going to be the high now for the foreseeable future for the pound, given that weaker inflation reading, because that's such a critical component for them to make decisions, and it's very hard to imagine that the Bank of England can remain hawkish at this point. Certainly, I don't think we're anywhere near a Bank of England rate hike. If you think that Christine Forbes has now left the Monetary Policy Committee, there's only 2 against 5. And I think the 2's argument has lessened considerably now that inflation has dipped. The next inflationary reading I feel from the UK is going to be the really important one. Because it's a question then is, was that a one-off dip? Or does it remain suppressed from that peak of 2.9, and actually we've gone over the peak now from that depreciation of the pound post what we had from the EU referendum last year. Okay, quick look then at the calendar for this week. A couple of headline topics to be aware of. And obviously when you look at a week in its entirety, what you tend to do on a Monday, and what's good to do, is look at the shape of the week to see where is the peak of interest, because that might dictate then where the bulk of the volume or the market attention will be centered. So you can kind of define then whether or not it's going to be a time for potentially range-bound trading, or you can be more proactive where there's going to be some outright market movement driven by a fundamental catalyst. So a couple of things. First of all, you've got the Fed. This week is the Fed decision, so that will come on Wednesday. And the Fed are holding their 5th monetary policy meeting of the year. Economists widely expect the central bank to leave interest rates unchanged. A couple of snippets here from Deutsche Bank this morning. They said the Fed is unlikely to take any action in a policy firming direction at the meeting this week, partly because inflation has continued to surprise to the downside as of late. On the topic of timing of the initial taper of the balance sheet reinvestment, Deutsche believe that a July announcement and August tapering has a low probability, given that recent softness in inflation, because Yellen did not take the opportunity at her testimony to more strongly signal a July announcement, and then thirdly, because market expectations are generally centered on a September announcement and an October commencement. So if you like, this particular meeting might just be a bit of a holding play or holding pattern for then the more interesting meeting to come in September for the actual announcement. And probably Fed commentary in the run-up to that to kind of guide the market into that announcement. So definitely something we'll be monitoring this week, of course, at the Wednesday evening, but potential that this could just be a fairly benign event. Investors looking at the statement for any tweaks to language tied to inflation in particular. Other things we're looking out for: US GDP. US economy believed to have rebounded in Q2. Wall Street estimates for GDP grew at an annualized clip of 2.5% in second quarter, above 1.4% that we saw in Q1. So we're looking for confirmation of that rebound, if you like, from weaker levels. We also get from the UK the same reading. UK GDP, that will come out on Wednesday. It will likely show UK GDP up 0.3% sequentially in the second quarter and up 1.7% from a year ago. The pace is expected to inch up from growth of 0.2% in the first quarter. And then probably one thing that you've definitely got to be aware of, because in terms of the number of companies reporting, it definitely starts to ramp up in US earnings season. So let me just scroll up here. We've got nearly 200 companies of the S&P 500. So this is the most busiest week as far as earnings season is concerned. The roster including a number of key headline companies: Alphabet, Google, McDonald's, Caterpillar, General Motors, AT&T, just to name a few. To give you a bit of a sense of how earnings season is faring at the moment, thus far 19% of companies on the S&P 500 have reported. So again, only a fairly small proportion, about 1/5. We've got the bulk of that will be covered this week, but 73% of those have posted better than expected earnings, an improvement to the 5-year average. So overall, earnings season has fared relatively well. I would say in summary, some of the weaker areas from last week were some of those tier 1 banks, apart from Morgan Stanley, which exceeded on every single division. Goldman Sachs, Bank of America, some of those other banks were a little bit weaker on their core and trading divisions. And you also had General Electric were pretty soft as well, and how the market traded their shares on Friday. But overall, earnings season has exceeded expectations, above what would be a 5-year average at this point in time. Looking at earnings, this is something that I do, and you can do the same on the Bloomberg earnings calendar, is start looking ahead at the end of each day for the next day in preparation of what are the big cap names coming out, so you can be best prepared. And generally speaking, at a glance, this is the week, so I'd look at, usually large cap is the one that's going to draw most of my attention if we're looking at index futures. As you can tell, Alphabet, as we mentioned, this is one of the largest companies on the planet, never mind just the S&P. And so Alphabet are going to be reporting, as per usual. Tech companies tend to report after the market close, as they will later today. So that might draw some attention at the open for any associated names in tomorrow's session. If we go to the next day, Tuesday, you got AT&T, Amgen. So going off a chronological order of market capitalization, 3M, McDonald's, United Tech, Eli Lilly, so a host of larger cap names. We go down to Wednesday, you've then got one of the biggest, I guess, kind of sentiment related stocks, social media, Facebook. They'll be after market on Wednesday. Then you've got Coca-Cola, Boeing, Gilead Sciences and so on. Going down then to the latter part of the week, another tech name, Amazon. So if you think about it, tech names tend to be a fairly good barometer, I'd say, for risk appetite. And how that has performed over the last quarter, we're going to find out in these latest numbers. And the tech industry is quite important from a market sentiment point of view. So you've got Microsoft, who we had last week, who are pretty good because of decent ground they've made in cloud technology. So we've got Alphabet, we've got Amazon, we've got Facebook this week. 3 real big heavyweights in that space. And scrolling all the way down to Friday, we start finishing, and this really spells coming towards the end of earnings season when you start getting the big oil majors. They tend to come at the bookend of earnings in the US. ExxonMobil and Chevron will come on Friday. So when we're getting to the open on Wall Street, you just want to be aware of how some of these bigger names have reported, as that might well add a bit of direction then as to the performance of the open on Wall Street trade. Just finally, one piece of news, and I'm sure you'll probably welcome this if you're an intraday trader and you follow this all the time. Probably the least eloquent man that's ever been a press officer at the White House, Mr. Spicer, on Friday has stepped down, no less coining the phrase, too many chefs in the kitchen spoil the broth, and in only the Spicer can. So he stepped aside, and so we've got new replacements coming in. And actually some of the replacements that I was reading at the weekend have been suggesting that they might try to control the president, Donald Trump, in just toning down slightly his kind of vehement attack on the media via Twitter, and generally his ill-timed broadcasts that he tends to make via social media. So we'll see whether or not they can have that effect. I would imagine not, knowing how Donald Trump has played out thus far. Looking at the actual economic calendar for today, and as I said, we've had the main major economic data of the morning, that being the manufacturing and service PMIs, which have been slightly on the softer side. Looking to this afternoon, we'll get the US equivalent, which is the Marquette manufacturing, and then existing home sales as well coming this afternoon. But if you would like to recap the entirety of the week, then please do have a look in your inbox in the morning research. I did send everything out to you. As I said, you've got the OPEC, non-OPEC meeting. I'll be looking out for comments of that throughout today. Actually, just as I'm speaking, seeing the Saudi energy minister says market return to bearish mood due to weaker compliance with cuts. Says it's only a matter of time before inventories return to a 5-year average. Says global oil demand growth shall be 1.5 million barrels per day in 2017. So a couple of comments just coming out to Saudi energy ministers as I speak. Through the rest of the week, obviously your oil inventory data, usual setup, APIs Tuesday, followed by the DOEs on Wednesday. And then going through into Friday, a few other data points to be aware of. Alongside the GDP reading, you've got Michigan PCE number, could be interesting. And the Baker Hughes rig count, which if I remember rightly, actually the rig count was up 1 on Friday. So, excuse me, it's down 1, so bucking some of the recent trend that we've had of consistent adding new rigs online. Again, the plateauing, if you like, slightly of what we've seen of late in oil rigs coming online might just be a bit of a telltale sign that actually even the shale industry is a little bit mindful of where the price of oil is trading at the moment in the long term, given the fact that they too don't want to see oil flirting down in the low 40s, because that also starts to become a little bit disruptive for their longer term investment plans themselves. As much as they'd love to capture more market share of OPEC, it obviously needs to be done in an efficient and able manner in terms of to be able to finance their ability to operate going forward. Okay guys, that's the briefing for this morning. Going to leave it at that. Let you get on with the session. So have yourselves a good day. Any questions, please feel free to message me in the chat room. And just as I speak, all at session lows.